Okay, thanks. But anyway, so like uh, a general partner is really the one who has expertise, who understands markets, who understands what the kind of investment is, knows how to create a business plan and then execute a business plan. It's the person who assembles the team around them to make a business plan successful. They establish the operating agreement, how the corporation will function, what to do when the corporation isn't functioning, the roles and responsibilities between the GPs and the limited partners, and the other operating legal documents, such as like the subscription agreement. They're the ones that secure all of the funding for the project. So it could be bank financing, it could be the limited partner investors. Um, then they manage all of the finances, then they execute the business plan, and they report back to investors and make disbursements back to investors. That's a good general overview of what a GP does. What a limited partner does is they're most active in the research phase. So we as limited partners have a big responsibility of researching what investments are out there, doing the vetting on the sponsor themselves, evaluating the opportunity. Does the business plan, does the slide deck, the deal deck make sense? Putting it maybe through some tests. And I have some tools that I'm going to be able to share with you about that. Doing our complete due diligence around the deal, making sure that we have a good relationship with the sponsors and that we feel good about them and that what we are looking at jives with ourselves personally, our ethos, our ethics, our financial goals. That our other responsibility is to read and understand the operating agreement and the subscription documents, which are very dry legalese and they're not that easy. AI can help with that because you can give AI commands to help interpret what that all means, but you still have to be the person who understands it and reads it. And then if you feel good about it, like I know both Melanie and Heather are in some sponsorship deals, that you set up an online account, you deposit your money, and then you monitor your investment, right? So you're reading quarterly updates, you're watching a quarterly webinar, like I watched one today. You are tracking what's coming in against what's expected. So you know if somebody's missed a payment or something looks like you have a question mark, you need further information. Um, but really at that point, you're pretty passive. It doesn't take a lot of time. You don't really have a lot of say at that point. So that's really what your role and responsibility is. One of the things that I really like about working through sponsors and private deals is that you get to benefit from the leverage of using your general partner. A general partner has a network. So they have a network of people, brokers, lenders, operators, um, people who are evaluating deals, the people who are doing all of the tax uh, preparation, all of their expertise. They have that network, and you get to get the tailwind off of that. They have specific knowledge that you can leverage, which is they have asset class expertise and then geography expertise. So they're in markets for a reason, and uh, one of their responsibilities is to explain that to you and make sure that you understand it so that you can ascertain whether or not they actually do have that expertise. And then you also can leverage from their time. So they're out there doing all of the work. They're modernizing apartment units. They're working their way through unproductive renters. They're filling the roles of renters with qualified individuals at market prices, whatever it is that they're doing. They're doing all of the work and you're mostly just the observer. So you're letting your money work for you through the leverage of the GP. So who can invest in alternative investments? And I've been a little bit worried about this because I know not everybody in the group is fully accredited. And then I did a little bit more work, and I actually think that pretty much everybody could that's in our group. And so the first definition would be people who are accredited investors. So that would be people who make, if you're single, $200,000 a year, if you're a couple, $300,000 a year in income, or if you have $1 million in investable assets, not including your home. So that's the standard accredited investor. But there's also a slot called substantial and pre-existing relationships. And so there can be slots in a generally accredited investment opportunity where non-accredited investors can get into the deal because they have a relationship. And GPs want to develop a relationship with you. And if you get into onto their email list, have an in-person interview, attend several of their quarterly calls so that you understand what their company's about and how they operate, how they communicate, that could start to build what is considered that substantial and pre-existing relationship. So the fact that, like Melanie, you know Chelsea and you have had that relationship, that allows you to get into one of her deals if they have those non-accredited slots available. Also, there are some alternative investments that do not have a net worth requirement. And we'll talk about that asset class or those asset class. And then also, I would say these kinds of investments really should only be ventured into if somebody has the willingness to do the homework, to learn the sophistication that they, to work into a level of sophistication that they need to understand what the benefits and risks are before they move into this kind of investment. So I think all of us qualify, and it's just a matter of whether or not it's right for you. So we had Forrest talking in February, and so you might wonder, like, what's in it for the GP and what's in it for the LP? Because often the GP does not get their share of the deal until all of the investors have received a very significant portion of their money back. And that could be like 5 years for them. And so what's in it for them? Well, in the big picture, the GP typically gets a split of ownership. And every deal is structured differently. They might have 10% ownership. They might have 30% ownership. They might have 50% ownership. Every deal is structured differently. But so by being the person who does all of the work and that brings the deal to the table, that guarantees funding, et cetera, they will derive ownership of partial ownership of the deal. So that's a big, big incentive. And they also can earn fees along the way. And this is considered appropriate. And you do have to review a lot of deals to know what is standard and normal and what's excessive. But some of the fees that they can earn are acquisition fees. So like when they go out and get a multifamily building and bring it to close, they can get an acquisition fee. Then having that asset under management, they get fees, but they also have employees that they're paying. So it actually helps to pay for their staff. It's not just that they personally are getting the fees, it's actually running their business operations. If they are guaranteeing the debt, so like if they have institutional debt, like from a bank, they might get a sponsor fee. And then on the sale of the project, they also might get a fee. And depending on how the fees are structured, some fees are better than others, but the ones that are good fees are the ones that are in alignment to incentivize the sponsor to do a good, to have good performance. And so that when we as investors do better, they do better. So that's the kind of fee that actually makes sense. So for me, like when I think about what's in it for me as a limited partner, that I can for, a concentrated period of time, but really for a limited amount of sort of physical effort, I can benefit from the execution of the business plan and derive its profits. So I can put my money to work. I don't have to do too much work for that. And that's a big benefit to me. I also like the fact that when I see a business plan and I see what their business plan is to pay out the LPs, I like being able to get a sense of how much money I'm going to make in a deal. And of course, like if I'm in the stock market, I have no idea. I don't know if it's going to go up. I don't know if it's going to go down. And it's not like these business plans go without a hitch, because like for the last 3 years, there've been lots of hitches because of the interest rates mostly. But anyway, I do just like having that sense of understanding, and also that I have the ability to evaluate the deal and think if I feel like they've made good assumptions or not, and whether or not that's a good investment that makes sense for me. So like I said, while not guaranteed, you can at least make an educated decision. And I like that. I like that a lot. Okay, so when you're in a group of like-minded investors, you all have similar goals, but here's some of the benefits, I think. One is that leverage that we talked about. So I, as an investor, can participate in a larger business or a larger business plan that I personally could do individually. So like as an individual, for example, I could never buy my own apartment complex. And I actually don't think I should personally, because one, I don't have the expertise to do it. And I wouldn't put that much money of my own money into one single apartment complex. So I like being able to be with others, spread the risk around, and have my money in lots of deals instead of just a few deals, or one deal. There are really outstanding tax benefits, and Melanie has been doing some of that for some of her clients, understanding that. But passive investments, especially through paper losses, such as depreciation and accelerated depreciation, can really look like any income that you're receiving is like a paper loss, and it comes out negative, and you can often earn money without ever having to pay taxes for it. So that's a fantastic benefit, and very different than what happens in the stock market. And then the third one is that unlike single family homes or the stock market, these kinds of deals can force value. And so like when I sell a house, the way that I sell a house and it gets valued is my realtor, or if I'm getting a valuation, they do comparables. What looks like this house in the neighborhood? What is a 3-bedroom, 2-bath starter home going for in this neighborhood? And then that's kind of like how we get to pricing the house, is what's it like compared to other houses in the neighborhood. But apartment complexes, businesses, self-storage, they're businesses, and businesses are valued according to net operating income. And if you have a good market, a good purchase price, and a savvy operator, they can do a lot to drive NOI. So they can drive down costs. They can install, water efficient toilets, sinks, and washing machines. They can do value add in terms of like remodeling, bringing everything up to date, and working through their renter pool to get rents up to market rates. They might be under market rates. A lot of the places that we've gotten into, the rents were well under the market, and they all had, a lot of them had a value add component to it to drive rents up. Adding services that cost extra, like storage sheds or pay laundry or whatever it is. Anyway, they can do a lot to drive NOI, and a little bit of NOI per unit ends up making a huge difference for the overall value price. So I like that about this type of investing as well, is that ability to drive appreciation. So there are risks, and you don't know what you don't know until you go through them. But so I'll just go through a couple of them. But I have definitely experienced some of this. The first is lack of control. Once you have signed the subscription documents, you are now beholden to the GP. They're in complete control of the deal. They're in control of the investment. They're in control of the business plan. And so finding a really, really good sponsor is like the key. Everybody says you should bet on the horse first, and then, I mean, the jockey first and then the horse. So finding the right sponsor is really important versus what the actual deal is, even though the deal is really important too. And so one of the things I really liked about what Forrest said to us in February, I asked him a question about, people, as you're vetting sponsors, whether or not how some of their deals went, and in good times and in bad. And so one of the things I really like about him is he's been in business since well before that real estate crash in 2008 and 2009. So he went through the very worst of it. And when you have somebody who's been through those cycles, you can actually find out, how did they react? What happened to their deals? What kind of communication did they have with their sponsors? How did they get through it? Did they lose money? Did they come out even? Were they able to do better than that? What kind of decisions did they make in a situation like that? Because that stuff is real and that does happen. And so finding the sponsor who has business savvy around those kinds of issues is really, really important. So like, what would affect the deal? And one of the things you'll get in a subscription agreement is a list of all of the potential risks. So the lawyer really goes in and just says, here's all of the potential risks that could go on. And so it's good to read through those and see if you feel comfortable with it. But like, changes in the market. So the biggest problem that we have been facing in this kind of investment environment has been the interest rates. And if you bought right when I started doing this investing at a pretty peak price, and then the interest rates went sky high, some of those deals got stressed almost immediately. Another one that happened, like one of our investments, beautiful, beautiful Class A apartment complex in Texas. After they purchased it, the county raised their taxes by a lot. And it wasn't something that they had been made aware of or that they could even research. It really happened, and it just changed the dynamics of their finances drastically. So, and another one like this one personally affects our single family home portfolio, but I know it also affects businesses, and it's insurance. Insurance costs are just insane right now. So that's part of your due diligence, is what kind of backstops or what kind of assumptions are they making about those things. And then the cost to purchase real estate, like in 2022, it was at the top of the cycle. Right now, actually, there's a lot more softness in the market. And so there's a lot better deals out there. And so that's an interesting thing to know. We're in a different part of the cycle. And then change in supply. So that could be, how easy is it for them to get the remodeling supplies that they need, the pricing in their remodeling supplies, but also the supply, the glut or the lack of supply of the kind of product that you're buying. So how big is the need for apartment complexes in that market that they want to buy in? So like, for example, Austin went through a huge building cycle, huge, and they delivered a whole bunch of brand new product in the last year. And right now, rents are soft because the population hasn't not absorbed all those rooms yet. And so I don't know that I would be purchasing in the Austin market right now, because if there's an oversupply, it won't be that way forever, but for right now, there's an oversupply. Salt Lake City has been on a massive, massive building boom too. And I've noticed that there's a whole bunch of apartment starts going on right now. And I'm curious about it. I don't invest in Salt Lake, but so I'm kind of curious about the oversupply. I don't know. But anyway, so these particular factors that we just talked about could all affect an ROI in the negative. And it can actually make some deals fall apart in the middle of it, and investors can lose their money because of these things. So this is part of the due diligence that you have to go through, and assumptions that you have to question, and really, really interview the sponsor before you move in. And so, and I do have 3 properties that I'm going to talk to you about, like what went well and what hasn't gone well. And so that I can give you some examples of how that looks to somebody who's investing. So we've talked about this in earlier ones, but I thought that I could just do a quick thing about alternative investing versus Wall Street. So one thing that's really nice about alternative investing, like I mentioned, is the tax advantages. So the tax laws really favor this kind of investing. They really favor real estate and businesses. And because there's all the write-offs that you can do, and especially through accelerated depreciation, there's just really no comparison. The public market offers almost no tax advantages. The only way you could really get some tax advantages is to do tax loss harvesting, I guess. That's a technique that people use, but really it doesn't compare to the advantages that you get in this area. Then accelerated growth, just the fact that you can use leverage for financing means that you can put in a fraction of the cost of the asset. The bank puts in the rest of the cost of the asset, but you keep 100% of the profits. That really accelerates your wealth journey. That's what works so well with single family homes, is that your down payment is so small compared to what the total amount the bank puts in, but you get all the equity. So that's what I really like about these investments as well. But one thing that you have to go into knowing is that they're illiquid. So I have investments that have as short a period as 9 months, but I have one that I thought was going to be 6 years, and now it's going to be 9 years. And there's nothing I can do. My money is just in the investment. There's not a secondary market for it. Or actually, they're starting to emerge a secondary market, but you have to sell at a steep discount if you're going to do it. And so also your investment is subject to the rules outlined in the operating agreement and in the subscription agreement. So you're really bound by that. Like they don't even want it. Like, say you found somebody, say you had $100,000 in an investment and you found somebody who would be willing to buy it from you at par value. A lot of the subscription agreements say you can't sell it to a second person, even if you found somebody. So that's important to know. And so Some of these, though, a lot of them, it depends on which kind of investment you're going for. They have cash flow. And the reason why cash flow is king in these kinds of investments is because with every payment that you get, you're de-risking your investment. If you put in $50,000 and every 3 months you get $1,000, you're just de-risking by that much money, and like if you get 50% of your money back, then you only have 25 still in. You've gotten 25 out, you've got 25 in. So cash flow really helps to de-risk an investment like this. Okay, so this was something I was trying to get Forrest to talk about, but I realized he talked about it in kind of a narrow way, and I wanted to talk about it in a much broader way to give you an idea of how many different ways you can get involved in small businesses. So, and this is just samples, the list goes on. I've heard so many creative ones and I keep hearing new ones. That's what's interesting is I keep hearing new ones. So residential, single family homes, multifamily homes, mobile parks, mobile home parks, and then funds that are invested in multiples of those, not just a single deal. So you can be in a single deal fund or you can be in a multi-deal fund. So that's an area. Businesses, so car washes, a climbing gym, coin-operated laundromats, marinas, hospitality. There's all kinds of businesses, restaurants that you can get involved with. Real estate. So specifically like a real estate play inside of a business plan. So self-storage, industrial parks, flex space, like flex industrial, retail, office space, ground lease, entitlements, parking. So I needed some of that defined for me. So a flex industrial would be like if you go into a smaller business park and you might have somebody who's running a cabinet making facility and they've got 2,000 square feet. And it's like got a garage bay in the back and maybe enough room in front that they have an office or a bathroom or something like that. It could be used as for a caterer where they store their catering truck and have refrigeration and a kitchen. But anyway, it's called flex space. And so that's what flex space is. That's really kind of a big thing right now. They're saying they can't build them fast enough because people want them so badly. A ground lease. This one was new to me. But like, let's just say there's a big company and they own a skyscraper in New York. And they're going to be expanding and they need money to expand. And they can't get the financing because of something on their balance sheets. So what they might do is sell the ground underneath the building. That's called the ground. And so then somebody owns the ground and then leases it back to them and it gets that off of their books. And so there's incentives to do this, but then it's a really long-term, really, really stable lease payment that these people who own the building pay to the ground lease company. So that's what a ground lease is. Entitlements is so Heather, you're in the process of getting entitled because you probably got this building. It probably wasn't zoned for daycare. So you have to go through all of the permitting process in order for it to be approved for your function, right? So like say there is a mall and they're going to do the mall is empty. It's been abandoned and they're going to turn it into multifamily homes or they're going to do something with it that's different than what the mall is. Going through that process of whatever that new function is going to be is called entitlements. When there's a farmland and it's zoned for farm and agriculture, getting it entitled so that a subdivision can be built on it is actually it's a business plan and it's very lucrative. And big national home builders like Holmes and Pulte and whoever else, they used to go in and do all the entitlements themselves, but because of the way that those markets have happened across time, it's better for them to buy it already done. And so like that's a big one. So anyway, that's what that stuff is. And then business expansion, and it could be really anything. It could be a company going into franchises or restaurants that are going to open up concepts in 5 locations, or a construction company that's just getting started. So you can invest in those. And then ground up development. So ground up would be anything that you're building from scratch. And so real estate for resale would be one, a new business that you're building from the ground up, industrial that you're building from the ground up, because it has its own risk reward profile. So it's different than like buying an existing facility. So that's why I'm separating it out. And then debt instruments. I really like debt instruments a lot. And those would be direct loans. I'm in one that's a fund. And so, like if you have a credit card and you get a cash advance, it's kind of like that it fills a cash advance need, short-term need for a business. So it could be a restaurant, it could be another kind of business. Banks aren't fulfilling those needs right now. And so they're going to these intermediate funds. But anyway, so I'm in a merchant credit fund. Non-performing notes is another one where you take people who are behind on their mortgage, you buy their mortgage from whoever is servicing those, and then you get them performing again. And you get that's a cash flowing kind of a investment. Finder funds, finder funds. So that's where you go out and look for existing businesses and you buy them, and then you put in professional management and grow them bigger and then sell them later. So that's a finder fund. You're aggregating and running and expanding businesses. It's kind of like what hang on. Why am I drawing a blank? Who is the most famous investor in America? He lives in Omaha, Nebraska. He just retired.
Warren Buffett.
Warren Buffett?
Thank you, Warren Buffett. So like that's what Warren Buffett did. When he first got started, he went and bought businesses, put in his people to manage them. So that's what he did with the insurance companies, with with quite a few of them. And so it's kind of like that, so that's what a finder fund is. And then energy is another big one. It could be solar farms, it could be oil development, natural gas fields, that kind of thing. So I hope this opened up your mind a little bit to what's possible and what kind of deals you can get into, because there's a lot and they're kind of interesting. They all have sort of their own profile and what makes them interesting. So when I look at investing, I had to really look about like, what did our family need? What were our financial goals? And so I know you guys have worked through that a little bit about what you are really looking for. So I'm looking for all of these, but for different and allocating different pots of money to each one. But the first one would be cash flow. I have cash flowing investments that either pay me every single month or on the quarter. So they pay a really good rate, like between 10 and 12% usually. And so you're getting a really good return, but they don't usually have an upside. So you don't get to grow your capital. You're using your capital and your capital is paying you every month, but you have a smaller upside. But the fact that you're getting capital back on a regular basis means that your investment is de-risked over time faster. So usually you would buy a stabilized asset with regular cash flow. So that might be like a Class A office building that has really stable base, and you get maybe 6% return on that. It could be a debt instrument, like just a direct loan that would be giving you monthly or quarterly payouts, or like a these distressed mortgages, those usually pay out monthly, or cash flowing businesses. And so like the exit out of those once you've gone in there is, so sometimes there's a term. So like when you have a direct loan, like some of them would be, it's a 9-month loan, and then the borrower has the option to extend it for another 9 months. So it might be an 18-month possible term, or it could be a fund, and it's a three, and you have to get the best rate of return, you have to commit your money for 3 years. And they just pay you, like one of ours pays us 12% every single month, but you just know that your money's in there for 3 years. So the exit would be the loan pays off, the term of the fund ends, or there's a sale of an asset. A big equity multiple, like if you're really looking to grow your money and have it grow in terms of multiples, then these kinds of investments are good ones to look at. So you have a much larger upside, but you also have a longer tie up of your money. So your time frame could be a lot longer. So what would that look like? That would be value add residential, where you're working to increase the NOI. It would be ground up development, and that could be for a business, for real estate, for multifamily homes, just anything like that, where you're starting at dirt. And then the exit would be the sale of real estate. So like I'm in one where we're building luxury condos at a ski resort. And as those condos sell, then that's when I would start to get my money back. But getting the building up and above ground is a massive effort in a lot of years. If you're in a business, then maybe it's the sale of a business, but you also might be getting cash flow from that business in the meantime. A multiple business roll up. I'm in several of them that have business plans where they're trying to build out a very wide number of these businesses, and then they're going to try to roll them up and sell them either to private equity or to an IPO. So that there's some really good potential upside with that, but it just takes a long time. Energy. So the biggest advantage to energy is that there are massive, massive tax benefits. You can write off 80 to 85% of active income if you make one of these kinds of investments. So if you have a really big tax year, that's a really potentially important one to consider. They can be risky. I have one that's, I'm in two, and they are risky. They are cash flowing, and they do have upside potential, generally speaking. And then on the exit, there's either the sale of assets, like I have one, well, I'll tell you about it when I get to it, but they have a sale of assets, or there's no exit, where basically they just have ongoing residual income for years and decades to come. So that's an interesting one. And then funds, like I'm in quite a few funds, and that it can combine both cash flow and upside, which I really like. And an exit for one of those would be the term of the fund ends, they've returned your capital and upside, and they also could allow you to reinvest in their funds and just build your rate of return by reinvesting in the fund. So those are some possibilities. Just around, these are mostly multifamily that I'm going to be talking about. And so Melanie, you may recognize some of this. And I know Heather, you're in a multifamily, I think anyway. So different strategies, different deals have different strategies. And so you can think about what your strategy is. So buy and flip, buy, rehab, and immediately sell. Buy and hold, which can include a rehab. You could rent it out, get it all fully rented, market rates, hold for 3 to 5 to 10 years. After stabilization, you could do a refinance out and to return partial or all capital to your investors while you still remain in the deal. That's a possibility. a ground up development. So that could be ground up apartments, office, self-storage, condos for resale, car washes. Um, and depending on what it actually is, you could rent it out for a seasoning period and then sell. Because again, sales have a lot to do with NOI. And so that's maybe why you have a seasoning period. Or you could rent it out and keep it. So you could develop it from ground up and then keep it. And then buy and watch would be, you don't have a business plan that says we're going to sell this in 5 years. You're saying you have a business plan that says we're going to wait until we can get the very best return for our investors. So we're going to buy and watch. Some of them have combinations of all of these strategies. And certainly some of the ones I have combinations as well. I'm assuming that you guys will ask questions if you have questions. So please feel free to do that. Okay, so one of the questions that you need to ask yourself is this a suitable investment for me? And does it suit my risk tolerance? And so as you've been doing your own, what money needs do I have? What are my goals around money? These are some things that you need to think about. So this is simple, but like, are you retired and looking for cash flow? Yes, that's me. I'm looking for cash flow. And so this one says maybe not ground up development because it takes so long to get your money back. And I'll tell you why I am in ground up development. And it has to do with my investing thesis. Are you young and have a big time frame? Well, then maybe that 6% steady cash flowing Class A apartment isn't a great one for you because there's just lower upside and you need more upside to grow your wealth. And then does these investments match your goals? And do these business strategies match what you need for a return profile? So those are all questions that you need to ask. And the way I like to think about it is like a roulette table. And I have slots that I need to have filled. And every year I'm trying to figure out what slot do I need to have filled. And so I really am juggling my investments according to what our needs are and what we're trying to accomplish. And I have 3 buckets really. And so I'll talk about that later. And then again, the risk. So the illiquidity, that's a big one. So basically, a lot of these business plans are 5 years. Some of them are a little bit longer. In the big boom years leading up to COVID, they were in and out in 18 months. So even though their business plan might have been 5 years, you really don't know. And it's really up to the GP to say. So if you have an emergency, you can't access that cash. And like I have a couple of them that have in their business plan that they're going to do a cash out refinance at a certain point in the business plan, but that might not happen. And I had one that said that they were going to fully refund or, cash out. And I got 20% out instead of 100% out they at least were successful enough that they could do the cash out refi, but they only were able to get out a smaller amount. And then I have another one that I'm waiting on for a cash out refi, which I hope really works. So then risk tolerance, like I think that a lot of these are not as risky because you always have a physical asset that goes along with it. I like that part of adding security, but you do have to evaluate, does it match your risk tolerance? The safest ones are the ones that are cash flowing on a regular basis back to you because of the de-risking of how much you have in there. The riskiest ones are the ground up development because they take so long and you have no idea what the market's going to do in that time frame. And so that's why they're riskier. And that's why they have a bigger return too, is to help reward you for that risk. Another risk could be that you're in something that's just too safe and it's not going to grow your wealth fast enough. So you need to have that's too safe and that's not risky enough for you. The other big one is the failure of the GP to either to have written a business plan that's not realistic or appropriate, or didn't execute on the business plan, or couldn't adjust properly to the change in the marketplace. So that I think is that's been something I've been experiencing, is just problems in the business plan in given the marketplace. And so that is really a risk. Um, okay. So this is where I'm going to share with you what we've done, what we're in right now, and how it like and why we're in it. Um, and feel free to ask any questions you want. Okay, so our financial thesis. So this I had to really think about this. I had this flipped earlier on to begin with, and then now I flipped it. So at first I thought what I wanted to do is save 2/3 of our assets and put it into high multiple, high equity growth investments, and for us to live on 1/3. And then I changed my mind completely on that and flipped it so that 2/3 of our assets support our lifestyle and earn less equity, and 1/3 are in the longer term equity multiple growth. And ideally, our assets should be in tax advantaged investments. And I really am aiming for like an average of 15% on an annualized basis for that's what my baseline that I want. It's harder to get that on cash flowing, but like overall, I want our portfolio to be growing at least 15%. And that in time, I also want to convert our assets from our 401ks to Roths, because Roths are much, much better to pass on to your heirs than 401ks. There's a lot better tax treatment. I mean, obviously better tax treatment. We would be paying the tax up front, and then the way that they can take it out is much more advantaged. And so that's kind of a goal that we have. And the reason why we flipped the percentages is because I started thinking about it and like, what if our assets really grew at 15%? And if you just get a future value calculator and you just start putting in, I have this much money, I have 20 years at 15%, I'm not going to contribute anymore. It comes out to a boatload of money, and like so much more than we have now, and potentially like problematic money for our kids later. And I thought that that would be something I'd be really proud, is to be able to leave an estate like that, you know? And then I thought, so what? So that our kids and my grandkids can enjoy it and we're dead? And it's not even that I don't want them to enjoy it when we're dead. I just want to enjoy it with them while we're alive. That's what it really came down to. It's just kind of like what we did when we were in Switzerland, right? Like we gave our kids cash so they could bring their families to Switzerland and spend time with us while we were there. So Madeline came in February with her 2 kids and her husband, spent 2 weeks with us. Megan came straddling February and March with her little family. And it was so meaningful to us to be able to share that crazy, wonderful adventure with them. And it just made it so awesome. And so I am just saying, we're going to be able to leave them plenty of money when we die, but we are going to do as much as we can to enjoy life together now. And also, I know I told you this, but uh, mortality stares at you. And I mean, I'm in good health and I'm physically in good shape so I can play and have fun. But no kidding, 2 days before we came home, I got a message that one of my favorite workmates of all time, his wife, died of cancer. And her funeral was going to be right when I got home. And, she's just a couple of years older than I am. And like that just happens right and left. And so you got to really seize the moment and enjoy life right now. So that's my thesis. That's my thing. Okay, so now let's go through and I'm going to tell you about our investments. So I've put down what bucket they fill for me in this 2/3, 1/3 tax. And I'll give you kind of the terms so you can get a sense. And if you want to look, and I'm going to show you one example from a company about how their investments work. I mean, like what they're saying their business plan is projecting for us as investors. So I'll show you one of their pages, but I'm going to just tell you as I go along. Okay, so PBR Capital's my favorite cash flowing. Well, one of my favorite cash flowing. It pays us every single month. You have to be in it for 3 months, 3 years, but it's 12% annually. And then they divide, whatever that number is, and then they divide it by 12 months, and then just they pay you on the first of the month and never fails. We started in 2022. My husband put some money in, and in 2024, I sold a house in my IRA and I put some money in. And then Kevin is going to re-up because it's been such a good cash flowing instrument for us. Then we have an investment in a Class A multifamily in Texas. And I also did this one as a cash flowing play. So they had 5 different classes of shares. They had Class A down to Class E. And each one had its own payout and own like structure of how they got paid. Anyway, I picked Class A because I really wanted cash flow. And this was the very first investment we made once we started selling houses and started looking towards investing towards retirement for cash flow. And so basically, I earn a 9% pref. They didn't pay it out for the first 6 months because they wanted to stabilize the property. Then they started paying it out, and they paid me every single month. And then last year, they missed a month. And then in September, they said we're in financial distress because of county taxes. And but the thing it was scary because like I have a pretty good chunk of change in there and I just was worried about it. But they said they had a series of investor meetings and they explained kind of a strategy. But when they looked at their tenant base, they qualified for attainable housing. And even though it's a Class A, almost A plus property. And so, but they had to go through a refinance and which was a whole rigmarole. And now once that went through, they had to get the application in to be considered tax exempt because they are in attainable housing. So they worked really, really hard. And I have been really impressed with one, their communication, which has been better than it was before the crisis. And 2, that they have been able to get as much done as they have. And hopefully this last part goes through. And if it does go through, then their cash flow is better, their NOI is better, and they may sell the property early, which would be fine with me because then I get my money back. And then they would have to catch me up on the preferred payment. So even though they've missed some, they would have to catch me up on it. And then because I'm a Class A share, I'm one of the first ones to get money back. So that's what that one is. Hedgerow is up. So I got 2 properties through a personal friend of mine who has a investment firm. And it's a class B in Memphis, Tennessee. I purchased a share in 2022. They've started paying quarterly about a year into it. And this was one where they had wanted to, after they got the remodeling done, got market rates for rent, they were going to refinance, cash us out, but we would stay in the deal to the end. And they like to hold their properties for about 10 years. And they did do a refinance. They returned 22% of the capital. And including the distribution, so far, I've gotten 33% of our money back so far. And then, and they resumed doing the quarterly distributions now that the refi has taken place. So this is a long-term hold. So we'll be in it probably for 10 years. Then equity growth. So this is the ground up development for condos up at Deer Valley East. And it's luxury ski in, ski out. We invested in 2022. They didn't start counting the start of the investment until sometime in 2023. But from the minute we put our money in, we're earning an 8% pref, which they make up first. So the timetable extended because of changes that Deer Valley wanted. They had to rewrite, they had to redesign a bunch of stuff, but they also got permission to go up an extra floor, and so we can sell more structures and more condo units. Their first payout now is not estimated until 2028. So you can see how long this is. And so they're going to pay the pref first, then they're going to do return of capital, and then they're going to give you the multiples. But they are selling at a higher price per square foot by quite a lot. And they have more of them that they can sell. And so now they have positioned it saying that we're going to be at the top of what their original expectations were. And so it's going to be like a 3.7% multiple, maybe a little bit more. So that's nice. It's just going to take a long time. Okay. Memphis 3, this is the same as that second apartment complex. This was kind of Class C multifamily, purchased it in 2022. It is a total problem child. It has never made a distribution. They've done 2 capital calls. Anyway, it's a long story, but the last quarterly report that I got, they're finally making excellent progress. And if they can get the NO up high enough, they just might sell it early and let it go. And so hopefully what that just means is I get my capital back without a loss. That's what I'm hoping for at this point. King Operating is cash flow, equity, and taxes. It's an oil company. And they had projections of like 10% every year. They have never hit that, but they do send monthly distributions. And so, they range from like $300 to $600 a month. And but I did get an 80% active income tax deduction when I got it. And then they have an upside because they're developing all of these oil fields and then they're going to sell it at a multiple. And so that's kind of like the exit idea. We'll see how that goes. The next one is a debt fund. It's just a straight 12% interest only loan. And it started out as a certain time period and then they renewed it and we agreed to renew our loan with them. And so that still pays, it just pays every single month. It works great. Clean Cars Fund is car washes, ground up development. We invested in this in 2023. And I said 7, but it's 5. It's 5 Tommy's car washes. 2 are in Nebraska, 2 are in Texas, and 1 is in Pennsylvania. One of them is getting ready to open next month. Everything else has gotten permits and funding, and they're just either waiting to break ground or they have broken ground. They, in their business plan, and I'm going to show you the business plan. Let me see, screen sharing. I'm going to stop the screen share and I'm going to just show you what their business plan says. Okay, this is the business plan right here. So this is what they shared with us. Can you see the Tommies? It's like a little spreadsheet with blue. So this is what they gave us 3 different return scenarios and a 5-year time frame. But like if you invested $100, their conservative was that you're going to get cash flow of 17% in year 3. That's a really high. And then 31% and 30% in year 5. And then you can see the multiples upon exit. So that's really nice. What they're trying to do now is, so we own 5. They're on multiple tranches, and they hope to actually build 50 of these things, different sources of money, different investing groups, roll them all together and either sell them as a package to a private equity investment company or do an IPO. But anyway, that really jacks up what your returns are going to be. So that's an interesting possibility. Okay, let me get back to my screen. I hope this isn't too much information. Is this interesting? Or helpful at all to see what we're doing? Okay, so that's okay. Yeah, there we go. Okay, so then we're in a credit fund. So I told you about that merchant credit fund. So that's a debt instrument to Main Street businesses for short-term cash needs. We're in one where we reinvest the cash flow, and so our corpus gets bigger over time, and they're targeting a 22% annual return with a doubling of our capital in the end. Let me just see the screen. Private equity equals finding funder. What are you asking on that, Melanie?
Oh, I wasn't asking. We were back when we were talking about the funds, you were talking about fund finders.
Finder funds. Finder
Yeah,
funds.
finder funds. That's what private equities are, is they just come in and they roll together a whole bunch of companies like what you were talking about with
Oh,
your car washes. And then they pull it all together, they run it for 3 to 5 years, and they sell it to another private equity group.
yes.
Like that's
Yes.
all they're doing is they're aggregating these companies.
Okay, thank you. So YSA is Your Storage America, and it is a qualified opportunity fund. And so that's why I have cash flow, equity, and taxes as the bucket that it fills. So we had a capital gains, we sold a house. I just immediately turned that money into this investment. And you have to stay in for 10 years. But at the exit of 10 years, whatever you've made actually is tax free. So it's very interesting that way. And so this one has a 4x multiple at the end. So we put in like 130,000. And so in 10 years, we'll have gotten 400 and whatever back, almost 500. And their business plan is to cash out refi once. So they're building it from ground up. It's really nice. I've been on a tour of every single self-storage facility in the Phoenix area from the GP. So I know this one's going to be really nice. And but anyway, the business plan is to cash out refi in time for my investment window where I have to pay the capital gains that have just been deferred, not not forgiven from the house that I sold. And their idea is to refi, give you your capital back in terms of a debt instrument, so it's not taxable. And then you can use that to help pay for the taxes that's owed on that capital gain. And then it starts cash flowing modestly in 2027, and it continues to cash flow. It's maybe like a 6% cash flow. It's not that much. But the big multiple is really at the end. And then it's tax free. So we just get all that money at the end. So that's an interesting one. Rockstar Capital. This one you put your money in, they pay you quarterly. They make loans to companies that do entitlements, land entitlements for subdivisions. And it's very profitable. And this one is the only one that I've seen that has a really good cash flow and a potential upside. So it's a 10% pref, and it's up to another 12 to 16% total with an upside. It just depends on what happens. And then they also, if you want to get out, you can get out annually. And you can also, if you don't want to use your money, you can just reinvest it. And so you are building that money faster, a lot faster. I like it. It has had a snag this quarter. I think it's just because there's closing on a bunch of property and it hasn't happened yet. And so it's not because that there's a problem with the business plan. It's just timing. RMC Group is just a straight loan. It's a 5-year, 10% amortized loan. So I get capital and uh, interest paid back on a quarterly basis. US Energy, this is another oil energy cash flow and taxes. So this is institutional quality. I think it's less risky than anything else I've done in energy. Massive tax benefit, something like 80 to 85% against my active income. They have projected 4-year return of capital, so that happens pretty fast, but then it's open-ended and it could last for 20 years. There could be some sort of dividend, sort of diminishing dividend over 20 years, just depending. FrameTech Alpha. So this was a ground up development, brand new company, brand new technology, patent pending. No, not patented. It is patented. And they opened and were up for operation. So I did this in 2022. And they started operations this year. It is going gangbusters. They're already talking about expansion into other markets like 5 or 6. And they also have that idea of having these different facilities. They created a parent company, FrameTech USA. And so I actually am now invested in both. So I get the manufacturing facility Alpha. I get a cash flow from them plus an equity multiple upon sale. And then I also have a piece of the entire company when they sell it. And so anyway, that one they think could go 10x in 10 years. We'll see. But for right now, like they've only been in operation, actual operation for about 6 months, and they're going gangbusters. They're doing fantastic. So that's exciting. Um, and then our last one that I'll talk about is just our single family homes. So we have long-term ownership for long-term rentals. We have 9 single family homes in Michigan, Indianapolis, Memphis, and outside of Orlando in Kissimmee. And we work with a kind of a coach who helps us look at our properties, and they project, including all the ways that you can make money with real estate, that will have about a 15 to 17% return annually. But we bought these houses, almost all of them in 2022. And then, the market has just been super, super soft since then because of the interest rates. And so we haven't gotten, and like these last 3 years, they just are sitting there. So we'll see. We'll see. So that, does anyone have any questions about our portfolio? Was that interesting to learn about what we bought and why, and like what they do, and like what you can even think about or imagine possibly happening for you?
Yeah, I mean, I think it's really interesting, Andrea, it's a lot of kind of different things to be involved in, and that's kind of fun, really, to see how all these different companies do and um, how they structure their deals, right?
Yeah. So I think what we'll do is we'll look at a couple of different deals so that you guys can see how different deals are structured, so that you kind of know what to look for when you're doing them.
hmm
What do you think, Melanie? I know you're in your first one right now. So what's been interesting about this discussion today?
The most interesting thing is, so I've joined a networking group for my business. Like, I'm networking with other business owners. Many of them are multimillionaires. And it's fascinating to me because these are the kind of investments that they're in. And for me, it was always like, I don't know, maybe buy a house and rent it. Like, I never thought that deep. I never really had my mind open to all the possibilities. But between Andrea's coaching and teachings that we've got going here, and the things that I'm picking up very, very piecemeal from the networking group I'm in, I'm just fascinated. Just keep going. I'm learning so much.
I love that so much. Well, that's honestly, there's no easy playbook for this. I mean, I put in hundreds of hours to learn how to do this. There are some really, really good resources that I'm going to turn you guys onto to help you in your journey. But like for me, this is just kind of a love letter because it's been so life-changing for us that I wanted to give back and to do this for other people. But just like trying to piece together, like even your investing thesis, like what are we trying to accomplish with our investing? Like that was like I've never done that before. And it just really became crystal clear in one of my master classes that I was in, um, what we needed to do and why. And also that leaving a pile of money to my kids without having experienced the fullest life with them possible right now, that made no sense to me at all, but like I had to get to it. I had to think through what like that looked like. And so I'm really hoping that this portfolio of ours is gonna get there, but you never know. And so but hopefully we're making some good decisions, and I also really stay on top of it. And I continue to look all the time because you never know if you're going to get something. Like I was not expecting to do one new investment this year, but two of them are talking about selling early. And so that actually could end up being like $250,000 that I have to place. Like that's a lot. And so to do that well, you have to know what's out there and what people are offering, or if this is a good time to, or is this a good time for me to just pay off my insurance loans and sit on it? I have to, so I'm trying to think like what will be the best thing to do if that should happen. I don't know. Um, but anyway, so what I was thinking is that we would keep talking along the same lines. We're going to talk about how do you find deals? What is the vetting process like? Like, what questions should you be asking? How do you start to develop a knowledge base so you're asking good questions and that you're understanding what it is that you're looking at? And I don't even know if we're going to be done by then. So I'm not going to schedule a guest speaker until I feel like we've really gone through and gone as deep as we need to go. So it just depends on how far we get. And because like Katie Buddha, who I'm excited about, they do debt. Anybody can get into that for any amount of money. So you could just do $10,000 and get an 11% loan, and it would just start paying you back right away. So that's an interesting one. They do real estate debt. And then Kevin is the guy that he does done for you real estate, and that's who my coaches were in real estate. And he has a whole theory about like how you can become financially independent, and it's 10 houses, and he can talk about like why 10 houses, how does that work, how does that make sense for people. But I'm not quite ready to now bring more guests in until we finished really understanding like how we do this. Does that seem good to you guys as we move forward?
Yeah, that sounds
Okay,
great.
Very good.
great. And then the other person who wants to come in and talk is that woman that I introduced you to that does the build for investor homes in Florida.
Ashton.
Yeah. Yep, she's somebody else who would love to speak. And there's maybe a couple more that we can bring in because it would be fun to hear from sponsors who talk about like what they do and how they do it and why they do it, like what you get out of it. So it's fun to hear that. But anyway, so I'm reminding you about this book. If you haven't seen it, this is on Bigger Pockets. That's where you can find it. But Brian Burke is now the co-host of Passive Pockets, which is the podcast that's specifically for passive investors on Bigger Pockets. And this is just a really good resource. It's just good, like a little handbook to have on hand. So, okay.
Hmm.
Any other questions? Anyone want to bring anything else up?
Okay, no.
Not really.
No.
I don't know. So, you?
Okay,
I think we're
we
good.
will reconvene on the 10th.
Okay,
Okay,
wonderful.
Awesome.
Thank you.
okay. It's so good to see everybody. Thanks for your patience while I was gone.
Of course.
Okay, take care.
You too. Good
Bye-bye.
night.